Welcome everyone to Daily Rates Live with the Mortgage Calculator. We'll wait just a couple of minutes here to get started. Let everybody have a chance to tune in. Let us go live on all the different platforms. In the meantime, we do have the chat up there on the screen, so feel free to drop a comment as you tune in. We'll get started here momentarily. I see some people are already checking in. Jason, Jamie, Samantha, Mark. Good morning, everyone. Hope everyone had a great holiday weekend and ready to get back to work here. Interesting. It's going to be interesting to see what the rates are looking like today for sure. We'll go through here shortly. After a 3-day weekend and a lot of stuff going on in the news, it's definitely going to be interesting to see what the rates are looking like this morning. So we'll get into that here in just a moment. Thank you for everybody tuning in, dropping comments there. All right, it looks like we are live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen there so we can get into it. So, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM and investor loans. And today's topic is going to be something right up our alley, which is 2 to 4 unit investment properties. So our sales manager, Jose Gonzalez, with 27 years of experience, is going to do a deep dive into that topic here in a little bit. But before we do that, we'll do what we do every morning, which is pull up the actual live rates for different programs today. So Nick, if you're ready, let's go ahead and pull up our pricing tool and see what the market is looking like this morning.
All right, let's check it out. Let me switch my screen and we will get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you'd like a full breakdown, please get with one of our team members. We have over 300 licensed loan officers in 24 states for primary and second homes, and we can do our investor business purpose loans in 44 states. This tool will show us the general rates and programs with the APRs. So if you'd like a full breakdown of all the costs that go into the APR, you can definitely ask our team, but we will show those. Today is May 30th, just after a long weekend, just after 11 a.m. Eastern. So we should have our new rates for this week live. As Kyle mentioned, a lot of activity going on and a lot of movement in the markets this morning already. So hopefully this is reflected. I would like to do the show later this evening if we could, once everything calms down, but tomorrow we'll see where everything lands. So for today's demo, we're going to set up, as we do every day, a nice easy scenario that we can compare across the programs. So we'll set a loan amount of $400,000. We'll set our LTV to 80. That means 80% loan, 20% down payment. We'll set our desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost. That's the typical request from our customers these days. So that's what we'll do in our demo every day. We will compare our conforming conventional programs to our FHA programs, and then we'll check out the expanded guidelines, aka non-QM, where we have 5,000 additional loan programs with alternative income options. We also have VA and USDA. Remember, VA is only for our active and eligible vets. So if you do happen to be a veteran, we can definitely quote that up for you. But since not everybody is, we don't do that live. And same with USDA, that's only for properties in a USDA eligible area. Do happen to be shopping there, we can quote it quickly, but not everybody is, so we don't do that live either. We start today with our conforming conventional. We will set a purchase, 30-year fixed loan, pretty standard, primary occupancy, single family property, 1 unit, state of Florida, county of Miami-Dade. And for all of our demos today, we'll set the estimated FICO score to 760 and the estimated debt to income ratio to 40. So with these basic settings, as we do every morning, let's check out the conventional rates. Okay, still a little bit high. Hopefully we see some downward movement. This was what I was hoping. We'll see better stuff this afternoon, I assume. this is about the same as it was last week. So the option we have here at the top, 7.125 rate with 0.875 discount points and a final APR of 7.287. So it's still showing a little bit higher like it did last week. Hopefully these relax a little bit this evening and we see some better action tomorrow. But for today, this is what we're looking like right this morning. So now we'll go back to our pricer, and remember we always compare APR so that we can compare the price apples to apples across programs. So our conventional option here at 7.287, we're going to compare with our other options here. So set this up to 80 LTV just like before. Everything else will stay the same. We will select FHA so we can compare our conventional to FHA. FHA does have a little more leniency on the credit aspect as well as a higher DTI ratio. So typically FHA is the next option that we go with if a borrower for some reason has trouble qualifying for conventional. But we'll keep everything else the same on this scenario so we can compare apples to apples. So let's check out the FHA rates for the same scenario. So here it is about the same as it was last week too, but great option, 6.5 rate for 0.75 discount points and costs and a final APR of 7.084. So again, I don't think these have gone down today really yet, which we're hoping for since the markets have reacted pretty positively to the recent news. But here you can see the FHA is actually a tad bit cheaper than conventional for this exact scenario, which is what we've seen a lot of times lately. So definitely recommend people out there shopping for conventional and FHA, definitely consider both. We'd be happy to quote both for you. And in this case, the APR of 7.084 is actually a little bit lower, tad bit lower in this scenario than the conventional rates, which were at 7.2 something. Hopefully we see both of those go down later today. Now, if for any reason our borrower has trouble qualifying for conventional or FHA, many other banks or lenders don't have other options. But that's where we love to come in with our expanded guidelines, aka non-QM, where we have 5,000 additional loan programs that offer alternative options. So we'll keep everything else the same here as our scenarios before. However, we have a new option that pops up with expanded guidelines, aka non-QM, where we can select different income. So full doc is what we typically use for FHA and conventional. That's 2 years of tax returns, pretty much what everybody is used to. So we typically choose this program to choose a different option. So we have different options for alternative doc, but specifically asset-related programs, business bank statement programs. We have our investor programs we'll talk about in a minute. We have personal bank statement, which is our most popular. Stated income, VOE, 1099, P&L, no income at all kinds of different options fall under this umbrella. But our most popular option here for a primary home purchase is our personal bank statement 12-month program. And that's for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, have various write-offs and may have trouble qualifying for different reasons, either qualifying at all or qualifying for enough income to get the property that they really want. So in this case, instead of using their tax returns, we're simply going to use their last 12 bank statements as their income verification to determine a debt-to-income ratio of 40% using just the cash in the bank statements versus the expenses listed there. So very easy program to qualify for most of our self-employed borrowers for much more income and qualify where they wouldn't qualify at all or qualify for that larger income amount and that house they really want. So these are great solutions for our borrowers. Non-QM is definitely something we're very excited about. So let's check out the rates this morning. And this is awesome. So as we see a lot of volatility in the conventional FHA rates that are right now, remember the conventional was at 7.2 something. Right now, we have a bank statement option for almost identical price, which is really unheard of, right? So we love when we have these great solutions, 7.25 rate for 1 discount point and cost and a final APR of 7.317. So just a tad bit above the conventional option. We can solve a problem for our borrowers typically that need a little bit of extra help. And it's almost the same exact cost today, guys. So those of you on our team, you definitely should get excited. You know, we all love non-QM. That's kind of our specialty. And right now, the non-QM is almost identical in price to the conventional. So definitely want to use that to our advantage, especially where you need that little bit of extra help. Definitely allows you a lot more flexibility. And if we scroll down here, there's a ton of different options that we have. Some of these may allow bankruptcies, foreclosures. Some of these may allow other little loopholes. So please get with our team. They'll find the different options that fit best for you. Now, before we pass it over to Jose, who will go into a deep dive on investment properties, obviously is our topic for today. We always want to do the live rates for investment properties. So if we switch the occupancy to investment, we're going to compare our two options there. So we'll set up the same LTV, 80% loan to value, 20% down payment, and we're simply going to compare our conventional conforming options for an investment property to our expanded guidelines, aka non-QM, because FHA, VA, USDA are not eligible for investments. So we're simply going to compare these two options. We'll set up conforming first. Keep everything the same as our other demos. All we've changed here is the occupancy to investment. So with all those same settings, let's check out our conventional investment property rates. So looks like this option's actually the best here. So 7.375 rate for 3.875 discount points, and final APR 7.637. So here for investment properties, the conventional loan programs have added additional loan level price adjustments. So unfortunately, we can't find an option for one discount point in cost here under the conventional options. So even though we go up in rate, many of our investors don't mind going up in rate a little bit to save money out of pocket. That's where we love to suggest our non-QM options. So let me go back to our pricer demo here and select investment property again. Set this to 80 LTV. And we can compare our conforming to our non-QM expanded guidelines options. Now we have to select our income. As I mentioned before, the investor DSCR, definitely our most popular income option when we're talking for an investment property. That's because it doesn't actually require any income from our borrower or any employment from our borrower. We're simply going to use the estimated rental income from the property we're purchasing in this demo to determine a DSCR ratio, a debt service coverage ratio for that property. If the rents can cover the expenses of the mortgage, the PITIA, that is a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. It generates a little more rents than it has for expenses. Now we still have options for DSCR values under 1.00 where the property doesn't quite cash flow on a monthly basis. So a ton of different options here for DSCR values that go from 0 all the way up to well over 1.00. So we will delete this for the demo today so we can see all the different options. And the final thing we have to select is a prepayment penalty that is standard for a non-QM investment property. We always select 3 years. That is the standard option. However, we can select 0 if we wish. That will limit our loan programs and cost us more. And we can select 5 years if we wish. Again, not all loan programs allow 5 years, so it'll limit our programs, but it will save us some money if we do select it. But for our demo, we always choose 3 years so we can see all the different options. So with these basic settings, let's check out our DSCR rates. So here, a rate still in the 7s here, which is awesome, 7.99 for 0.975 discount points. So again, we've solved our problem for our investor. We've gone up a little bit in rate and saved money out of pocket, the discount point cost here, so they can invest in other rental properties. And the final APR is just a little bit higher here, 8.0, so just over 8% APR when the conventional, I think it was 7.8, I believe, that we were just at. So a little bit higher here for non-QM, but a lot of flexibility. Remember, no income, no employment, no W-2s, no tax returns. We're simply going to use our rental income from our property. So our investors, whether you're doing one property or you own many of our investors start multiple loans, cash out multiple rental properties, purchase multiple more, because these don't require any income docs from the actual borrower. We're simply going to do the rental property. So as long as it makes sense, you can do these loans and have multiple. Tons of options here, as we mentioned. DSCR values vary on these different options. Some of these may vary on the prepayment penalty option. So please get with our team. They'll find the one that fits best for you. Some of these options at a higher rate may allow things like short-term rental income if you're purchasing a short-term rental property, which is going to be one of the things we're talking about tonight in our training. So these are great options here. Remember, we did this all on a 1-unit property for all of our demos today. So investors obviously love single family 1-unit properties. But what Jose is going to go into, let me go ahead and switch my screen here. Jose is going to go into our deep dive topic today, which is going to be multi-unit investment properties. So our investors love single family, obviously, but a more popular probably option these days, especially with the values that we're looking at, more bang for your buck oftentimes, are the multi-unit investment properties. So for 2 to 4 units, definitely some loopholes. You know, we love the non-QM options, so I'm sure Jose has some options queued up there where non-QM can exceed the LTVs and some of the other restrictions that we have when we go conventional. So I imagine Jose has a couple different angles pulled up here where we can attack the multi-unit option. Remember, when we have a multi-unit property, most loan programs, whether it's conventional, I guess not FHA or VA, those are the only loopholes there. But most of the loan programs do adjust the LTV pretty significantly between a 1 unit and a multi-unit property. So these are the challenges we have to navigate as loan officers when we have investors that want to purchase multi-unit, but we love to have solutions. And that's where we love to present the non-QM side by side with obviously the typical conventional. And I'm sure everybody will be surprised here on some of the non-QM options and the loopholes that we can offer there, as well as the sometimes overlooked VA, FHA, and other loophole options there where they don't actually restrict the LTV. So if you're ready there, Jose, let's have you go ahead and take over.
Yeah, good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. What I'm doing here this morning is just putting a little context into the different types of loans that we do, a little bit deeper than the quick analysis that Nick shows in the morning. Because what I want to make note is that many times the non-QM options are going to have a higher LTV or better, usually it's going to be higher LTV, better property type situation than you would with the conforming loans, which are going to go up to a maximum 80% LTV for a full doc investment property option. Usually that's going to be the case. Now, and I also wanted to show the difference between analyzing this, which is the main point here, the difference between analyzing it as a 1 unit property and as a 2 to 4 unit property, right? A lot of times we may forget that when we are looking at a 2 to 4 unit property, the LTV is usually going to be lower. There will be an LTV adjustment when you're analyzing a 2 to 4 unit property versus a 1 unit property. So when you are looking at those guidelines with those maximum LTVs and stuff, keep an eye on the unit count, because more often than not, the best case scenario will be for a 1 unit property. As soon as you go 2 to 4 units, there will be a drop. Sometimes it may not be with 2 units. Sometimes it may be with 3 or 4. So keep an eye on that, but there will almost always be an adjustment when you're going multi-units instead of a single unit. So my first example here, I wanted to show you how this actually works, right? So here we have what would normally be in most people's minds, the most restrictive option, right? You're looking at DSCR, right? But here, keep an eye out on the fact that we're looking at a 1 unit property, not a 2 to 4 unit property. So here we do have our maximum LTV of 85% for that DSCR property. And these are pretty good rates here. Our loan amount is $425,000 for this example. So this is 1.75, I think 1.75, 1.875, I think is the cost here in points. And this is for 15% down DSCR for a 1 unit. So now to show you an example of what happens now, if we go 4 unit, and now 2 to 4 unit is going to be the same, but if we go 4 unit, you will see our max loan amount is now $400. We are now at an 80% loan to value. we're still looking at good rates. So you're looking at 8.875 with a little bit of a lender credit, and you can buy it down all the way to 7.75. Whereas in our 15% down one unit, it was 9.25 costing, I believe, 1.875. So it does get, so there's about a little bit over a 2 point in cost swing. So be aware that your 85% is realistically an 83% because the borrower has 2% higher cost to get into this loan, coupled with a higher rate. So there is a cost here. So this is our 2 unit again. So now I wanted to show you an 85% 4 unit full doc loan. So investment 85% LTV is our highest LTV for the investment property. Now again, this is non-QM because, as I just mentioned,
Yeah, you didn't do any conventional examples to compare it to, huh?
no, I don't have any.
Gotcha.
Didn't have
What's
any.
the limit? Let's just say the limit, I guess, every time you go over this.
Yeah, the limit on the agency is 80%, right? 80% LTV on a full doc best case scenario. So here, this is our, and that's not for a 4 unit, by the way, either. That's for a 1 unit property. 4 units probably going to drop a little bit on the LTV there as well on your agency product. But here, you're looking at
It'll be 75 on a 4 unit. Yeah.
You're looking at 8.75, and that looks to be around 1.875 cost and fee for our, and buy it down all the way to 7.99, and that is 85% full doc for the 4 unit. Now, I'm not going to do the 1 unit, just to note that actually on the 1 unit, it's still 85%. It doesn't change there. But now, when we go into our bank statement option for the 4 unit, it will reduce our LTV to 80% because normally your bank statement option for a 1 unit investment property is 85%. But now, when you add the 2 to 4 unit mix, it's 80%. So you do have very good rate here, by the way, at 80%. That's $500 lender credit at 8.25% rate. And check this out. You can buy it all the way down to 7.125% rate, which is amazing when you consider how, remind you what we're talking about here, bank statement 4 units, 80%. So that's pretty incredible when you're looking at those rates. Those are,
and the limit conventional is 75. Remember,
Yep.
So this is not doable with an agency loan of any kind.
Yep, you're looking at rates there that are definitely agency rates. So then, a little bit more context here. Profit and loss. You see, let's look at our bank statement rate a minute. So you can see the bank statement rate is 8.25 at the lowest cost option. Now, P&L is going to have a little less verification, right? You're verifying with a profit and loss prepared by an accountant. In some cases, depending on the option, they may ask you for the last 3 months bank statements just to corroborate the information on the P&L, but there's not as much review as there would be for the bank statement loan, which you're looking at least usually 12 months review of cash flow for the business. Same LTV, you get 80, but your rate is 0.5% higher for the P&L option for the 4 unit property at 80%. So 8.75 has a $500 lender credit, 7.25 will cost you a little bit of over 3 points. And then for our last example here, just wanted to show again the 4 unit 80% LTV DSCR purchase, which is the maximum LTV for a DSCR loan if you have more than 1 unit. The 15% down was the 1 unit option that I sent you. And for whatever reason, they view 1 unit as less risky than a 2 to 4 unit, hence the adjustment in the price. So here we're looking at 8.875 with a $600 lender credit. And let me switch over a minute to the 15% down option. So you'll see it's a substantial difference. 9.125 costing you 7,800, and over here 600, 8.875, which is what I was mentioning. The difference is about a 2 point swing, more or less, in the cost, and 0.375 or 0.25, excuse me, that would be 0.25 swing in the rate. So you have to explain this situation very carefully to your borrowers so that they understand that the benefit is net 3% less money out of pocket and a higher payment. And usually what's going to happen with the 15% down option, that the limiting factor is usually going to be the debt service coverage ratio for the program option is not going to be met, because normally the 15% down option does have a higher DSCR requirement of 1.25. So is a benefit here, but the main thing I wanted to show is that at a 4 unit, there is an effect when you go from a 1 unit property to a 2 to 4 unit. So that would be the main point of today's rates examples, is for everyone to know that there is a difference in pricing when you're looking at a 1 unit versus a 2 to 4 unit. A lot of times we forget that. We're looking at the guidelines real quick. We go, oh yeah, it looks good. The matrix looks good. Everything is good. And we're talking to people. And then all of a sudden we send them the quotes, or we're looking for information and we can't find anything. We think we made a mistake. And the issue is usually unit count.
All right.
Yep. So remember, the agency multi-units are going to be limited for investment properties. The only loophole there is if it's a primary. So this is not about the little loopholes as a primary, which are required for FHA, VA, and some of the conventional little loopholes that you might hear about for high LTVs are for when it's a primary. Obviously, you can rent out the other units if you have a multi-unit. But what we're talking about here is a straight investment. And that's where we see a ton of benefit on the non-QM, where non-QM LTVs always, every example Jose gave today, exceeded the agency examples, right? Which is the conventional examples. Conventional is going to limit us at 75 on an investment property, multi-unit at all times. So that's going to be our limit. Every example Jose just gave exceeded that limit. You didn't have any 75s, right, Jose? That was all 580s and 85s.
Yep, they were blowing away agency. With room to spare.
Exactly.
And the rates as well.
Yeah.
Absolutely.
All right, cool. We had one question here that popped up earlier. Obviously, this isn't about Jose's presentation, but Monica was asking about PMI. Great question. So we did the demo at 80 LTV, which doesn't require PMI on conventional. So that way we don't have to talk about PMI necessarily. Obviously, that's a concern when you exceed the 80 LTV. And our demos with FHA, the PMI, it's not called PMI, it's called MI, but it's baked in there, right? So that's why we always look at the APR, which includes all of those costs for the FHA. So even though I didn't really talk about it today, probably as much as I should have, that is baked in the FHA example that I gave. And since we did not exceed 80 LTV, we didn't have to address it in the conventional example that we gave. But good question. Thank you.
But to let her know, all non-QM loans are never subject to any mortgage insurance at any loan to value.
That's one of the beauties of non-QM as well. Don't have to worry about PMI at all.
Yeah. All right, so great info there for our loan officers, for any investors out there. If you're looking to take advantage of some of these programs, you can contact us at themortgagecalculator.com or email us info@themortgagecalculator.com so we can pair you up with one of our 320 loan officer consultants from all across the country. Now, we do this show at 11 a.m. Eastern every single weekday, where we go through the live rates and then do a deep dive into a different topic every day, like we did today with the 2 to 4 unit investment properties. So thank you, everyone, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.